Welcome back to the deep dive. Today we're cracking open the latest from Delta Airlines. We've got their Form 10Q right here for the quarter ending September 30th, 2025.
Exactly. And this document, well, it's more than just numbers. It's the inside story on their financial health, how they're operating, the big strategic moves they're making this year.
Our mission, as always, is to pull out the critical stuff: profitability, debt, loyalty program power, give you that complete picture.
Understand how they're navigating things, especially after all the, turbulence of the past few years.
Okay, let's unpack this, starting with performance. Q3 2025 looks really strong on paper, a big leap from last year.
Huge leap. But we do need to remember Q3 2024 had some, shall we say, unique challenges. Still, the numbers themselves are impressive.
Right. So operating income for the quarter was $1.7 billion. That's up $287 million compared to Q3 24.
And net income also climbed, hitting $1.417 billion. Last year, it was $1.272 billion.
Which translates to earnings per share, $2.17 for the quarter.
Yep, $2.17 diluted EPS, up from $1.97. So definite improvement there for shareholders.
And looking at the bigger picture, the first 9 months, the year-to-date numbers look even better, don't they?
They really do. Year-to-date net income for 2025 is sitting at $3.786 billion. Compare that to $2.614 billion for the same period in 2024. That's a massive jump.
Wow, over $1 billion more in net income.
And they did this while expanding. Capacity, measured in available seat miles, or AFMs, was up 4% for the quarter and also 4% year-to-date.
So more flights, more seats available, and significantly higher profits. It shows a strong recovery and growth path, especially given how volatile things have been.
Definitely. But let's dig into where that money's coming from. The revenue side needs a closer look.
Agreed. Let's get into the revenue deep dive.
Okay, top line first. Total operating revenue for Q3 25 was $16.673 billion. That's up almost $1 billion, or 6% from Q3 24.
Sounds fantastic, but here comes the asterisk, right? The comparison year, Q3 2024.
Exactly. We absolutely have to talk about the CrowdStrike factor. You remember that massive IT outage in July 2024?
Oh, yeah, grounded thousands of flights. It was chaos for days.
Right. The filing actually puts a number on it, about 7,000 flight cancellations, and an estimated direct revenue hit of roughly $380 million just in that quarter.
So when we see that $996 million revenue increase year over year for Q3 25.
You got to remember almost $400 million of that is just getting back to normal after the outage. It makes the real underlying growth drivers even more important to identify. The comparison isn't quite apples to apples.
Okay, so where did the actual growth come from then? It seems like a split story within the plane itself.
Very much so. It's really a tale of two cabins. Premium products, think first class, Delta One, Premium Select, they were on fire. Revenue there jumped $460 million. That's a 9% increase.
9% is strong. And they specifically mentioned who's buying those seats.
Yes, and this is key. The filing highlights strong demand, particularly from corporate customers. Business travel in those front cabins is really robust for Delta.
Okay, but what about the back of the plane, the main cabin?
That's where the pressure is. Main cabin ticket revenue actually fell. It was down $246 million, or about 4%.
Down 4%, while premium is up 9%. What does that signal? Are they letting go of some economy passengers to focus purely on higher fares?
It certainly looks like a conscious strategy. They seem focused on revenue quality, not just filling every single seat. They know the premium and corporate segments are highly profitable, and maybe, just maybe, they're willing to let some lower fare leisure traffic go to competitors if it means keeping those margins strong.
Interesting trade-off. But the bedrock under all this ticket revenue, the real cash machine, is the loyalty program, isn't it? SkyMiles.
What's fascinating here is just how massive and consistent that program is. Loyalty travel awards revenues, so people redeeming miles for flights, that was up $130 million, or 13% just in Q3.
13% growth on redemptions.
But the truly eye-popping number is the cash they get from selling miles, mainly to American Express for the co-brand cards.
Okay, hit me with it.
For the first 9 months of 2025, total cash sales from these marketing agreements reached $6 billion.
$6 billion with a B.
$6 billion. That's up 10% from the prior year. Just in Q3 alone, Amex handed over about $2.0 billion in cash for miles.
That's just incredible. It's like a separate, high-margin business bolted onto the airline. That cash comes in no matter what, right? Fuel prices, flight delays, Amex keeps sending checks.
Precisely. It's an incredibly stable, high-margin revenue stream, a huge financial cushion.
Okay, so loyalty is booming. How did things look geographically? Mixed results there.
Yeah, a bit more varied. Domestic passenger revenue was up a solid 5%, but internationally, the Atlantic region was down 2%.
Any reason given for the Atlantic dip?
Seems linked to that softer main cabin performance we talked about, and maybe some shifts in summer leisure patterns. Latin America was also down slightly, about 3%.
But one region was a bright spot?
The Pacific, strong growth there, up 10%. That's clearly reflecting their network restoration, getting flights back into places like China and Japan post-pandemic. They're making up ground.
Makes sense. Okay, so that's revenue. Let's flip to the cost side. More flying, pay raises, expenses must be up too.
They are. Total operating expense rose $709 million, or 5% in Q3. No huge surprise there.
And salaries are a big piece of that.
Yep. Salaries and related costs increased 5%. That reflects the base pay increases. They gave 4% for most employees back in June 25, and pilots got 4% starting in January 25. Those costs are baked in now.
Okay, standard labor cost increases. What about the big variable fuel?
Now here's some good news for them. Aircraft fuel and related taxes actually decreased, down $177 million, or 6% in the quarter.
Decreased, even with 4% more flying. How?
Pure market prices, mostly. The filing says the average market price for jet fuel dropped 8%. That drop was big enough to more than offset the extra fuel they burned flying more miles.
So a bit of luck on the market price there.
Partly luck, but partly strategy. This is where Delta's refinery, Monroe Energy, comes into play. Their secret weapon, sort of.
Right, they own their own refinery. How much did that help this quarter?
Quite a bit. Monroe supplied about 75% of Delta's domestic jet fuel needs, roughly 200,000 barrels a day. And critically, in Q3 2025, the refinery generated a benefit of 5 cents per gallon for Delta.
A benefit, so it made their fuel cheaper than just buying it on the market.
Exactly. Compare that to Q3 last year, when Monroe actually added an extra cost of 3 cents per gallon. So that's an 8 cent per gallon positive swing directly because they own the refinery.
That's a significant impact when you use millions of gallons a day.
It really is. Now, the refinery's own operating income year-to-date was down a bit compared to last year, $42 million versus $76 million, mostly because the prices for the other stuff it makes, like gasoline sold externally, were lower. But its main job, hedging Delta's fuel cost, it did that very well this quarter.
Yeah, you can see why they hold on to it despite the complexities. So overall cost control, how do they do on the unit metrics? CAM.
Total CASM, cost per available seat mile, was up 1%. Not bad considering the capacity increase, but the really telling number is non-fuel unit cost, or CASM-X.
CASM excluding fuel, what did that do?
It increased only 0.3%. Barely moved.
Wow, so despite the 4% pay raises baked in, their core operational costs per seat mile were essentially flat.
Exactly. It suggests really solid cost discipline across the board on things management can directly control. They're running the airline efficiently, outside of that fuel price volatility.
That efficiency and cost control must be helping their balance sheet efforts. They've been very vocal about getting stronger financially, paying down debt.
They have. And the Q3 filing shows real progress. Their total liquidity cash plus what they can borrow quickly is healthy at $6.9 billion.
With the debt reduction.
They've been aggressive, made $3.9 billion in payments on debt and finance leases just in the first 9 months of 2025, clearly prioritizing cleaning up the balance sheet.
And they were smart about how they managed the remaining debt too, weren't they? Some refinancing action.
Very smart. Back in June and September, they did some key moves. They issued $2 billion in new unsecured notes.
Well, unsecured, meaning no collateral backing them.
Right. And at pretty good rates, 4.95% and 5.25%. They used that cash to pay off a chunk of the higher interest payroll support program loan from the government. Classic move to lower interest expense.
Shows the market has confidence, letting them borrow unsecured at those rates.
Definitely. But the move that really caught my eye involved that powerhouse asset we keep talking about, SkyMiles.
Ah, the September SkyMiles credit facility amendment. Tell us about that one.
Okay, this is quite strategic. They basically refinanced the big loan that's backed by the SkyMiles program. They pushed the maturity date out to October 2028, which gives them more breathing room.
Okay, extended the deadline. Did they get a better rate?
They did. Lowered the variable interest margin to SOFR plus 1.50%. Good execution there. But the really big change was the required principal repayment.
What did they do there?
They slashed the mandatory annual principal amortization payment from 20% of the loan balance down to just 1%.
Wait, from 20% down to 1%?
1%. That's a massive reduction in the cash they have to pay back each year on that specific loan.
So that frees up a huge amount of cash flow that was previously locked into mandatory debt repayment.
Exactly. We connect this to the bigger picture. It's a brilliant move. They lock in lower rates, push out the maturity, and dramatically increase their near-term cash flow flexibility, all by using the SkyMiles program as collateral. It just underscores how valuable and powerful that loyalty asset is.
And the credit rating agencies noticed all this improvement.
They did. Moody's gave them back their investment grade rating, Ba2, back in February 25, and then Fitch upgraded their outlook to positive in Q3. The market sees the improved financial stability.
Which lets them do other things like investing in partners. Saw their equity investments grew quite a bit.
Yeah, the portfolio value jumped from about $2.8 billion to nearly $3.9 billion year to date. Big stakes in Latam, Hanjin Cal over in Korea, and Wheels Up. They even extended the lockup on their Wheels Up shares, showing some commitment there.
Okay, looking ahead now, future commitments. Still spending big on new planes.
Oh yeah, the fleet modernization continues. Expected capital spending for all of 2025 is around $5.0 billion, mostly aircraft.
And the order book is still massive.
Huge. Total future purchase commitments sit at $16 billion. That includes big orders for the Airbus A220s and A321neos, and also those 100 Boeing 737-10s they ordered.
Are they actually getting all those planes on time, though? We hear so much about delays.
That's a fair point. The filing does explicitly mention that ongoing supply chain and manufacturing issues have delayed some aircraft deliveries originally planned for 2026 into later years. So even Delta isn't immune to those production headwinds. Their average fleet age, by the way, is currently 14.8 years for the mainline.
Getting younger slowly. Okay, one last quick item. Any update on that big, long-running lawsuit? The capacity antitrust case?
Right, that one's been around since 2015. The update is that Delta's attempt to appeal a prior decision was denied in September 2025. So the case moves forward into class discovery. It's still a potential long-term risk to keep an eye on.
Okay, so let's wrap this up. So what does this all mean?
It means Delta's in a strong position, but it's a very specific kind of strength. Profitability is up significantly, yes, but it's heavily driven by premium cabins, corporate travelers, and that incredibly lucrative SkyMiles program. They're successfully managing costs, especially fuel, thanks to the refinery, and they've made really smart moves to strengthen the balance sheet and reduce interest costs. Seems like a clear strategy. Focus on high-value revenue, leverage the loyalty program, and control costs tightly. Margin over sheer volume.
They definitely have financial flexibility now, maybe more than ever. Which leads to a final thought. They got back to investment grade, they're paying down debt, yet they just refinanced that SkyMiles debt to require less principal repayment, freeing up cash. Given that SkyMiles generates that unbelievable $6 billion in cash in just 9 months, how do you think they'll continue to use that specific asset? How does leveraging SkyMiles shape their whole financial strategy and growth path for, say, the next decade?
That's the billion-dollar question, isn't it? They've essentially built their own internal bank, backed by incredibly reliable cash flow. How they deploy the power of that bank, whether for faster fleet renewal, acquisitions, shareholder returns, or weathering future downturns, that's going to be fascinating to watch. It gives them options few other airlines truly have.